Are rising interest rates making you a little bit nervous about your retirement? Yeah, if so, you're definitely not alone. In this explainer, we're going to cut right through all the noise and give you a really clear-eyed look at what's happening. We'll break down the financial pressures, we'll decode what the experts are predicting, and most importantly, we'll walk you through a concrete survival guide to protect your nest egg.
Okay, let's just dive right into this with the single most important question for anyone on a fixed income. We see the stock market bouncing around every day and it gets all the headlines. But there's a much quieter, more persistent force at play here, and that's inflation. Its effect on your actual buying power, well, that's what truly matters. And here it is. This is the hard number behind that feeling you get at the checkout. You might hear the official inflation rate, the CPI, is around 3.8%. But honestly, that just doesn't tell the whole story for retirees. So while the government might be telling you one thing, your receipt from the chemist or the supermarket, it's telling you a completely different story. When you actually look at the things seniors spend money on, we're talking essentials like healthcare, insurance, utilities, the real cost of living has jumped by a staggering 5.7%. Now that's the number that shows the real squeeze.
So what's the official response to this squeeze? Well, it all comes back to the Reserve Bank of Australia. They're the ones whose job it is to control inflation, and their main weapon is, you guessed it, interest rates. Let's take a look at their current game plan, a policy that everyone started calling higher for longer.
Okay, think of the RBA like a doctor trying to bring down a patient's dangerously high fever. In this case, the fever is inflation. The medicine? Raising interest rates. Now, the doctor knows this medicine has some serious side effects. It makes borrowing more expensive, it can slow the whole economy down. So, after inflation just surged back in late 2025, the RBA started giving us the medicine, hiking rates up to 3.85%. And now, what they're saying is they need to keep that dosage high for a while, just to make sure the fever is well and truly gone. And that right there is the higher for longer strategy.
So now for the interesting part. How does this high-level policy, this medicine, go from the RBA's boardroom and land directly in your household budget? This is where all those abstract percentages become real dollars and cents, affecting your mortgage, your savings, and, of course, your super.
For any retiree still carrying some debt, this is where you feel the pain first. I was just talking to a retired couple the other day, and they told me their mortgage repayment has jumped by over $100 a month. They said, that's our weekly budget for catching up with friends over coffee. Just gone. It sounds like a small thing, right? But those small things really add up, and it's a direct hit from these rate hikes.
And look, this isn't just a few sad stories here and there. We're talking about a massive nationwide issue. 1.3 million households are now officially in mortgage stress. To put that into perspective, that's like the entire population of Adelaide plus a couple 100,000 more people all struggling to meet their repayments. It's a story playing out in every single suburb, every regional town, and retirees are often some of the most vulnerable.
Okay, this point is so crucial. It's a concept that can really sneak up on you. Think of your super like you're on a treadmill. You get your statement and you see your balance grew by, say, 1.5% last year. And you think, great, I'm moving forward. But here's the catch. Inflation has cranked the speed of that treadmill up to 5.7%. So even though you're putting in the effort and your balance is technically growing, in terms of what you can actually buy with it, you've gone backwards. That is a negative real return, and it is silently eating away at your retirement savings.
So this all leads to the million-dollar question, doesn't it? What happens next? Do these rates keep climbing, or have we finally reached the peak? Well, if you're looking for a simple answer from the experts, you're not going to find one. Right now, the financial world is pretty much split into two very different camps.
And this just perfectly illustrates the uncertainty we're all feeling. In one corner, you've got the financial markets and the big banks like Commonwealth. They're looking at low unemployment, they see people are still spending, and they're betting that inflation is going to stay stubborn. That'll force the RBA to hike rates at least one more time. But in the other corner, you have respected commentators like Alan Kohler and a big survey of economists. They're looking at the underlying trend, which is that inflation is slowly falling, and they're saying, whoa, the medicine is already working. Any more would be an overdose.
The whole logic behind that no-change forecast really comes down to this economic idea of a neutral rate. Think of it like the Goldilocks setting on a car's accelerator. You want to be going fast enough to make progress, but not so fast that you're redlining the engine, right? The neutral rate is that sweet spot where the economy is just cruising along, not overheating into inflation, but not stalling into recession. Alan Kohler's whole argument is that our current rate of 3.85% is already pushing the accelerator past that sweet spot. The policy is already tight. It's already slowing things down. Any more hikes would be like slamming on the brakes for no reason at all.
All right, let's move on to what I think is the most important part of this whole explainer.
What can you actually do about all this? Because look, regardless of which forecast turns out to be right, you are not powerless here. There are practical, actionable steps you can take right now to build a fortress around your finances. So we've broken this down into a 5-step financial defense plan. This is not about panicking. It's about a calm, methodical review of your situation. We'll cover how to make your cash work harder for you, how to manage your debt intelligently, and how to find new ways to bolster your income to fight back against these rising costs. So, here's the crucial point. While high rates are tough on borrowers, they can be a gift for savers, but only if you act. Leaving money in a standard transaction account right now is like leaving ice cream out in the sun. It's just melting away. Let's get specific. If you have $10,000 in an account earning 0.5%, you're getting just $50 a year. But right now, high-yield savings accounts and term deposits are offering over 5%. That same $10,000 could earn you $500. That is a huge difference, and it's literally money you are leaving on the table if you don't make the switch.
Okay, now for the other side of the ledger, cutting your costs and boosting your income. An offset account is honestly one of the most powerful tools you have. Let's do the math again. Say you have a $500,000 mortgage at 6% interest. If you have $50,000 in savings just parked in an offset account, you're only paying interest on $450,000. That's a saving of $3,000 in interest in the first year alone, and it's completely tax-free. It's all about being proactive, reviewing that budget, and making sure you claim every single rebate you are entitled to.
And this just brilliantly illustrates the core message, doesn't it? It is so easy to get caught up in the fearful headlines and the day-to-day uncertainty. But the one thing that all sound financial advice has in common is this: a calm, strategic plan will always outperform a panicked reaction.
So we'll leave you with that question to think about. Is your current financial setup forcing you to react to every little economic shift? Or is it actually built for resilience to withstand these pressures? By taking the steps we've outlined today, you can actively shift from a position of just reacting to one of resilience. And that can give you real peace of mind no matter which way interest rates turn next.